Welcome, everyone. My name is Liz McDonald. I am the broker owner of The Rental Girl. And once a month, we do a Buy Curious webinar for our clients, our renters, who are curious about buying and want to know what it would take to buy, what's involved, what do they have to do to start planning, and to start, answering some questions and to give some information so that, kind of like as an inspiration to renters to think about what they can potentially get into. So we do this webinar once a month, the first Friday of every month. And today, I'm going to talk exclusively about tenants in common, TIC sales. And I decided to do a whole webinar about this because it's a new market in Los Angeles. Tenants in common is kind of like buying a condo, but different. And it's perfect for entry-level buyers, for renters, first-time, homeowners, because tenant in common sales are a little bit less expensive. So anyway, that's what this webinar is about today. It's about tenants in common. So welcome to the webinar. And here's my contact information if you want to screenshot it. And everyone who's joining the webinar today, I can send you a link to this webinar once it's over, so you can rewatch it or grab everyone's contact information. I've got with me today Brita. Brita's our sales agent, one of our sales agents. Hi, Brita.
Hello.
One of our amazing sales agents here at The Rental Girl, and a huge fan of The Rental Girl. And so if any of you after the webinar have more questions or want to find out more about TIC sales or just about buying in general, definitely reach out to Brita and give her a call. Her email and her phone number are there. And then also we've got Henry Jeans from Sterling Bank. Henry's up in San Francisco. Sterling Bank is from the Midwest, but they have a huge presence in San Francisco. And they've been offering TIC, tenants in common loans, in San Fran since the 90s, I believe. Right, Henry?
About 2006, actually.
2006.
In
Okay.
terms of
Okay, well, there you go. And Sterling Bank recently came to LA a few years ago, and they're actively promoting their TIC loans here. And so this opportunity that we have to buy TIC sales is largely due to the fact that we have Sterling here now offering these loans. So Henry's going to talk about the financing aspect of it. Anyway, so to get started, this is what I have on our agenda for today's webinar. It's going to be about 45 minutes to an hour. I talk fast, so pay attention. I'm going to talk briefly about why we're having this webinar, why I'm super excited about tenants in common, about TICs. We're going to talk about, I'm going to go into what is tenants in common, and that's going to be the bulk of the webinar. That's about 25 minutes. I'm going to talk to you about the benefits of TIC, the process to buy a TIC sale and getting the loan and the loan process. And then we'll briefly discuss the difference between TIC and condos. And then we'll, at the end, have a few minutes for Q&A, question and answer. Okay, so why TIC? Why tenants in common? We have single family homes, we have condos. Why do we need TICs? What's the big deal? Well, I'm very passionate about the TIC movement here in LA because I started The Rental Girl when I was 23. And I've been working with renters for the last 17 years. And we're here at The Rental Girl, we're always trying to inspire renters to become future homeowners. So, and also I hear a lot from our renters that they don't feel like they're ever going to be able to buy. I hear a lot, I get a lot of feedback from renters that they feel like they're constantly trying to save and they can never quite save enough. And when they do save enough, the market's changed and then they can't afford. So they're constantly chasing the market. So I feel like renters just sometimes give up. And for years, I've been trying to inspire and empower renters to become homeowners. And it seems like it's impossible sometimes. And also we work with hundreds of renters who are qualified to buy, but they're just priced out of the neighborhood that they want to live in, or they can't qualify to buy, they can afford to buy here in LA. So this is why I'm passionate about TICs, because Tenants in Common is providing entry-level, affordable homes, basically, for, that demographic, for our clients. And it's giving, it's providing this opportunity for renters who normally wouldn't have that opportunity. So that's why I'm super passionate about it. And for landlords or investors selling a TIC, it's an investment opportunity. So, and then for renters, it's an opportunity to buy when they normally wouldn't have an opportunity to buy. So it's a win-win situation, which I like, because, oftentimes one person benefits and the other person doesn't, or vice versa. So I love that it's a win-win situation for everybody. Okay, so let's get into what is Tenants in Common. Tenants in Common is basically a way to hold title. It's when you buy a property, single family house or condo, you can hold title as John Doe, just in your name. Or if you're married, John Doe and your partner's or spouse's name. Or you can hold title as, community property, the two of you as community property. Or you can put your name, or you can start a corporation or a partnership or a trust or an LLC and hold title in the corporation or trust or corporate. Or you could buy a property with multiple people, like friends or family. And if that's the case, then you would hold title as either joint tenants or tenants in common. And joint tenants basically means that, let's say you buy a property with your brother and you pass away. Your brother would inherit your share. As tenants in common, if one person passes away, their share gets willed down to their heirs. As tenants in common, you can take your ownership portion and sell it. So if you buy a property and hold title as tenants in common, you could, let's say you buy 50% of a property with a friend, you could sell your 50% down the road. Okay, so just to sort of illustrate it, sole ownership, you've got one person buying one house, it's one property, it's one assessor parcel number. Community property is two people who are married, buy a property together, there's one assessor parcel number. Joint tenants, tenants in common, is multiple people who are either related as friends or family. They buy one property together with one assessor parcel number. The definition of TIC is it's a form of real estate asset ownership in which two or more people have undivided fractional interest in that asset, where ownership shares are not required to be equal, and where ownership interests can be inherited. Each co-owner receives an individual deed at closing for his or her undivided percentage interest in the entire property. In brief, a TIC owner has the same rights and benefits as a single owner of the property. So TIC ownership is tenants in common. It's been around forever. Like, this is just a way to hold title. How it's been done before is, generally speaking, it's always been done by friends or family members, people who know each other. Like, you just find a friend and you're like, let's go buy a duplex together. And you pull your funds together and you get a loan together and you locate a property and you buy it. And then one person lives in one unit and your friend lives in the other unit. And that's great. Well, the way that we're presenting it today is unrelated people, like multiple people who don't know each other, can get together and buy a property together. And you're not relying on having to find a friend who's in the same financial position as you or ready to buy. You can basically just buy a portion of a property without having to worry about finding partners. So basically, you have one owner of a property. Let's say he's a landlord or an investor, and he owns a 4-unit building. That's one property. It's a fourplex. It has one assessor parcel number. Now, four individual people can get together. Unrelated people can get together and say, I'm going to buy 25% of that property. I'm going to have exclusive rights to Unit A. Partner B is going to have exclusive units, use rights to unit B, and so on. So that's how we're presenting today, and that's what and that's kind of what the TIC concept is about. And the benefit, and just to go into that, so the reason why it hasn't been done before like this is because of the loan. For 4 people to buy one property together, you have to get one loan. And now that Sterling's offering fractional TIC loans, one buyer can get a loan on 25% of a property. So you can have 4 loans on one property. I'm going to get more into that in a little bit. Okay, so the benefits of TIC. So let's talk about the benefits for the seller. So I'm going to talk about the benefits for you, the buyer, in a second. But first, it's important to know, why would a seller sell their property like this? Why wouldn't they just go sell it to one investor? Rent out all the units and then just sell it to one person, which is generally how investment properties are sold. They're, an investor finds a property, he leases it leases it out, all the units out, and then he turns it around, he sells it to another investor, or down the road sells it. And the seller benefits by selling each unit individually, because generally they can profit more. They can make a little bit more selling each of the units, or however much more, selling each of the units individually versus selling it as one property. So that's how the seller benefits. But we see the benefit as instead of the sellers trying to find one investor to buy their property, which is they're limiting their buyer pool, right? Because how many investors are there? There's a lot of investors, but there's a lot more buyers who want to buy one portion of the property. So they're opening up their buyer pool to more people. They're also providing an opportunity. They're providing an opportunity for renters and entry-level buyers to get into the real estate market. And then also, we see this at the TIC and fractional loans. We see the future opportunity here and new possibilities opening up. Let's say you are a renter and you live in an apartment building, and your landlord says, "Hey, I want to sell my building. I'm going to sell my building just to let you know, give you a heads up. I'm putting it on the market." Instead of all of the renters sort of freaking out, well, what's going to happen? Who's going to become our new landlord? All the renters could get together and say, let's buy the property from our landlord. So stuff like the, who knows? I don't think all of us on this webinar right now can even, dream of all the different possibilities that there are. New markets are going to emerge, and this is sort of an exciting new one. Okay, for the buyer, TICs offer an opportunity to buy in a neighborhood that you might be priced out of. So TICs offer opportunity, and then the other thing that we've started to see with TICs is that it's an opportunity to become a mini investor, is how we're referring to it. So we're finding these entry-level buyers come to our TIC sales, and they want to buy it and then rent it out. They might not have $2 million to buy an entire fourplex, but they have $500,000, or they can qualify for a loan of up to $500,000. And they can buy 25% of the property. So again, it's just providing opportunity. TICs are adding more inventory to the market at a lower cost, creating a new market opportunity. So we see this as bridging a gap between renting and owning. TICs are more affordable. So we have TIC sales in San Francisco. They've been doing these sales, the loans from Sterling just started in the 2000s, but they've been selling TIC units since the 80s. So we have statistics from San Francisco of what's going to happen and how it works. What we know from San Francisco is that the values of TIC units generally are 10 to 15% less than comparable condos. So TIC units are more affordable. TICs are a great investment. So even though you're buying it at a lower price than a comparable condo, it's still going to appreciate with condos in the single family house market. So it's still a good value, and it's good investment. Okay, so let's talk about the process to buy a TIC. And just to sort of give you some context here, our company has represented so far 5 or 6 TIC properties. We've closed on about 13 units so far, and we've got a lot more in the pipeline coming up. We just listed 3 TIC units a few days ago, and we've got about 8 more coming up in September, and quite a few more coming up before the end of the year, and more coming every day. So we have a lot of TIC units coming on the market, and we're not just the only brokerage. There's other brokerages out there who are going to be listing TIC units soon too. So you've got this new market coming. You know, what do you got to do to buy one of these? So Henry, let's talk about the loan process. If there's renters on this webinar right now and they're wondering if they can buy a TIC, they're going to call you. We'll have them call you. What are you going to tell them? What does that conversation sound like?
Sure. So yeah, if you can hear me.
Yep.
Essentially the process, I mean, let me just back up and explain what a fractional TIC loan is, because that is what we're talking about here. When a building becomes and converts itself to tenancy and common ownership, there is an agreement that is generated, a TIC agreement, and it outlines the specific relative value percentages or the ownership percentages that each unit represents and that you're going to buy. If you're buying the top one, that may be 40%, the middle one might be less, the bottom one might have to be worth more, but that is what you're buying. The fractional loans that we offer are essentially then going to be the loan secured to just that relative value percentage that you're buying, essentially the exclusive right to occupy, the exclusive use to occupy that space that you're purchasing. That is what you are buying with the TIC, and the fractional loans allow for there to be a first lien mortgage just secured to that exclusive right to occupy that you're purchasing. This, in essence, then allows for there to be multiple first lien mortgages on a given TIC building, let's say 3 units, so that everyone has, in fact, their own mortgage and is not connected with anyone else in the building in terms of their mortgage. This is, of course, important. If someone else in the building defaults, it will not affect you, or vice versa. It really truly keeps the financing independent and allows really these TIC buildings to resemble and feel like condominiums from that regard, and that's obviously important. This type of loan structure and arrangement has existed since about the mid-2000s, 2005, 2006, after the state of California essentially upheld that owners have the right to own exclusive parts of building and live in them as such. So that was kind of a watershed time when this questions were answered on TIC ownership, and sort of the market as we know it now basically kind of started. So that being said, a TIC loan application process is really no different than if you went into another bank and just applied for a house loan. We underwrite according to Fannie Mae guidelines with income requirements, asset requirements, credit requirements, etc. Just kind of a few general points to start with. We can do financing as little as 10% down, as Liz's slide shows here. That arrangement can come either with the addition of mortgage insurance or maybe with an outside second. Internally, otherwise, we normally can go to 80% without issue, or 85% with the first and second. And any financing below that, if you have more down payment, it becomes pretty straightforward. But we are the only TIC lender that will actually go up to 90%. 6 months reserves refers to the fact that once the down payment and the closing costs are accounted for, we still need to evidence the ability to cover the full principal, interest, tax, insurance, mortgage payment for 6 months. So you need that 6 reserve cushion. That might be a little bit more than a traditional Fannie Mae loan where maybe a 2-month to 3-month reserve cushion is needed. So there's a little bit more there. And in terms of our credit scores, we do generally require a 700 FICO to act as the middle score, 720 if you're financing 80% or greater. So in that range is where the credit scores need to be. And let's see here. So now moving on to interest rates and loan programs, what type of loan programs are there available? Well, one important feature to know is that fractional TIC loans are ARM-based. It is adjustable rate mortgage financing only at this time, and that is kind of how the market has been characterized for about the last 10 years. The participating banks in this market are still just offering ARMs. ARMs will range in rates anywhere from around, well, programs from around a 3-1 ARM to a 7-1 ARM. And I can kind of go over those details. Currently with Sterling, our rates will range anywhere from around 4.125 on a 3-1 ARM up to 4.75 on a 7-1 ARM. So the range of rates is in about the 4% under current market rates right now. But it is important to be comfortable and knowledgeable that you're getting into an adjustable rate mortgage and how it can adjust over time. And that is one feature about fractional TSC financing that is important. So then in terms of pre-approval process, that is no different than any other lender process. We're just going to begin to review, receive an application, review credit, income, and assets and everything. And upon that, go over any items that may come up. But if not, then we're in position to issue a letter of pre-qualification or approval so that on a particular TSC unit. And again, these loans and the purchase contract, as Liz will be able to tell you, are just for that fractional share of the building. You're not writing a purchase agreement against the whole building. No, you're just really writing it against that 25%, let's say, of 123 Smith Street, what have you. That is everything that we're applying for here. That is the entirety of the mortgage process.
Yeah, and I just want to add here, Henry, that, okay, so a couple notes from my perspective. So regarding submitting an offer, if you're working with a realtor currently, your realtor may not be too familiar with TICs, because even though it's hugely popular up in San Francisco and they've been doing it there for a while, it's new to us here in LA. So if you work with a realtor, have your realtor call me or the listing agent of the TIC that you're interested in, and we can help get your realtor the information needed to write the offer and to go over logistics and stuff. But
I will just add here, Liz, let me just add that up in San Francisco right now, this is a very common and significant part of the real estate market in San Francisco, and it has been essentially since the mid-'80s. There was an attorney whose name is Andy Serkin. He basically modeled TSC agreements after CC&Rs, and he saw the opportunity to create essentially exclusive use and fractional arrangements within buildings, thereby kind of unlocking new forms of real estate within buildings. And for the last 30 years, it's been an ever-growing part of the real estate landscape up here. Somewhere between 7-10% of buildings are essentially classified as TICs, and the market is, there are always TICs on the market, and it's, anyway, a very established part of the market up here. It is growing, however, throughout the state of California, down a lot of coastal communities, and now into Los Angeles, where a variety of pressures, condominium conversion pressures, rising market prices, and just a lot of the characteristics right now that go along with real estate in California are all leading. So.
Yeah, good point. So Henry, the pre-approval process to get approved for a TIC loan, what I've noticed is it's very similar to getting approved with another lender. Quite often I get buyers asking me if they have to go through Sterling for the loan. They're already pre-approved with another lender, and they're wondering if they can just use the lender that they're approved with. And the answer to that question is no, you have to go through Sterling to get the TIC loan, because currently Sterling Bank is the only lender offering these TIC fractional loans here in Los Angeles. But if you are approved with another lender already, then what I found is those buyers generally don't have a hard time getting approved with Henry. It's a very similar approval process. So everything that you submitted to your first lender to get approved it's the same thing. Henry's going to be asking for the same thing. There's the standard loan application and the corresponding documents. And the other thing I just wanted to touch on is the interest rates and the TIC loan programs that you guys offer. The interest rates I think are comparable to what other lender, what the prevailing rates, right? So that doesn't seem to be an issue. A lot of buyers do prefer that 30-year fixed rate that, you know, a loan that's amortized over 30 years and the rate's fixed for 30 years. So when I first started getting into TIC sales, my first thought was, oh shoot, this is going to be a problem for buyers. They're not going to want to get a loan that's where the interest rate's not fixed for 30 years. And I was sort of concerned about that. But after I started selling TIC units, what I realized is that the buyers who were coming through our open houses and who were buying these units, they didn't care because they were just grateful to have an opportunity to buy in LA. They're not looking to buy these TIC units as their end all be all home. This isn't like, you know, where they're going to raise a family and grow old. Their TIC units are sort of like a way to get into the market, start building equity, and then a few years down the road, cash out and buy the house with the white picket fence. So, you know, really, I think you got to look at TICs as an opportunity to get your foot in the door. And, you know, the 5-5 ARM loan program seems to be what most buyers have gone for so far. And that guarantees your interest rate for 10 years. You know what your payment's going to be for 10 years. And then, Henry, what happens on year 11? Like, how much can the interest rate go up?
So backing up for a second, the 5-5 that Liz is means it's a fixed rate for 5 years of 4.5%. And I don't think we'll get to a slide that has the rates, but it's 4.5 for 5 years. When it adjusts, it can, through the mechanics of the caps and the adjustment features, cannot go any higher than 6.5% for years 6 through 10. So that gives you that 5.5 worst case scenario for the first 10 years. At year 11, if interest rates warrant and indices and rates need to go up, it can go up to 8.5%. So that would where it would go to. And you know, you do need to be comfortable and understand when you go into an ARM, the lifetime ceilings on these, in case the 5 is 9.5. So it's 5% greater than your starting note rate. So the worst rate that can happen over the 30-year life of the loan is 9.5%, which people need to be comfortable with. That is obviously higher than the market rate. And so a lot of times what we find up here is that, and people need buyers need to be very sort of cognizant of this, is just that you're going to find opportunities if you're looking at a TIC arrangement. You're going to be able to find property for less. You're going to be able to get more property for your money, as they often say. But you have to be comfortable with the ARM arrangement and getting into an ARM. Some people, they're comfortable only with 30-year fixed. And if that's the type of person you are, then you will have to reconsider this, in other words. But there's many others who basically understand that this is the arrangement, this is where it is, and they're comfortable with it and they're comfortable proceeding. But I make sure to tell everybody that you've got to be comfortable with an ARM.
Yeah. And what, in San Francisco, what are TIC owners doing after year 10? So what are your options? Because I think, you know, we probably have a lot of first-time homeowners, a lot of buyers, potential buyers on this webinar who don't understand this at all. And so they're going to wonder, like, well, what happens on year 11? Like, what are the options?
Well, you always have the option to refinance again into a new lower fixed rate, and we're starting to see that. TIC loans that I helped with 8 years ago, I've been here 12, are now coming back, and just simply in the last 10 years of interest rates have been low enough so that someone can have waited that long and now go back into a new fixed rate or a new beginning fixed term and get a low rate again. So that's a nice sort of just feature that exists right now with interest rates. Now, if interest rates go up, of course, people will have to evaluate, you know, where their balance is, what their payment is, and what their objectives are, and how long they're planning on holding the TIC unit for. If, in the case, someone who buys to live in it, but then after 8 years decides to move, there might still be an investment opportunity, and they might want to then hold on to it. So over time, it will come down to what their balance is, what options are on the market for refinancing, where the market interest rates simply take these mortgages to, and do other lenders come onto the scene with other options as well. That will always be the sign of a progressing market. You know, up in San Francisco right now, there are about 5 banks total who offer these, and so it's a pretty vibrant market. I think Los Angeles will get to that point where there's more banks involved, and that will, of course, give people long-term more options. And I think looking out 10 years, that should be the case if, trends continue to move in the direction they are.
So basically, your interest rate may or may not go up. I mean, it might go up a little bit and you can still afford it. And so then you just keep the loan. Or if it's going to go up and you're unable to afford the mortgage payment on year 11, then at that point you can refinance, like you were saying, and for better interest rate. And or you could sell and move into a bigger property or a nicer property or a different location or whatever, which is how I sort of see it happening. Because I feel like TICs are really just like get your foot in the door, like get it, like we're finding that these TIC units are the cost, the mortgage is about what the rent would be with 20% down. So if you come up with 20% down, and even some of these with 10% down, the mortgage payment is, especially when you consider the tax benefit, right? So your payments to buy a TIC unit might be as much as it would cost to rent it. So, if you're looking at it like this way, okay, you can either rent for the next 5 or 10 years, or you can buy a TIC, pay the same amount every month, and get in and start building equity. And then in 10 years, okay, if the interest rate goes up, it goes up. Sell it and buy something else or refinance. But at least for the last 10 years, you've been building equity and you've gotten your foot in the door. And I really feel like, this
and presumably at that time too, the market will be many more units on the market. In other words, in San Francisco right now, there are many TIC units on the market at any given point in time. It's a very liquid, fluid market. And it's very easy to price these out. It's very easy to compare them, to get appraisals, et cetera. It's a very established market. And I think Los Angeles will certainly be heading in that direction in a short amount of time. And will certainly establish a lot of those characteristics over the course of the next 5 to 8 years.
Totally. Okay, the other thing I wanted just to make a comment on is the minimum requirements to get a loan with Sterling. I'm imagining that some of the buyers or potential buyers on this webinar are probably thinking, okay, but that sounds great, but my credit score is 650, or I don't have 10%. Like I don't even have, I don't have 6 months payments in reserves in my bank account. So let me just address those buyers, potential buyers right now. If your credit score is less than 700, there are ways, there are things you can do to improve your credit. So there's boostmycreditscore.com, which you can pay a small fee or a large fee depending on how much you need it to increase. If you call us, we can help you work on improving your credit. This might not be something you can do tomorrow. This might not be something you can do in 2018. But if you have a credit score and you know you need to improve your credit score and you know these TIC sales are coming up and this is something you can get into, start working on your credit now. Because it might take you a year to work on your credit, but if you don't start now, if you don't have set that goal, then your credit's never going to change. So set a goal to improve your credit. Call me, call Brita, call Henry. We can help you with that. We can refer you to people and to companies who help improve credit score. There's creative ways to get around that and to work towards improving your credit score. Next is the 10% down. Okay, so I think this is probably going to be the biggest concern for a lot of people is like, well, how do I save the 10%? Or how do I save the 20%? Or how do I get that money? I don't know about you, Henry, in San Francisco, but in LA, a lot of the buyers in Los Angeles are borrowing and stealing to get their down payment. They're going to family, they're going to their aunt at Christmas. And if you just start talking about it, if you start telling people, hey, I think I might want to buy, and you start sharing this desire to your family, who knows what possibilities could come from those conversations. You'd be surprised at how many people are going to want to help you. You might get a gift from a family member and say, here, I'll let you borrow this cash if you pay me back in 10 years or whatever. So, get creative. And if you want some, we love to kind of have these conversations with renters on how to get creative. So if you want to call us, we can help you. Here's another thing that could happen. I don't know if this happens in San Francisco, Henry, but here in LA, a lot of times properties are getting sold, investors are buying buildings, and they're going up to the tenants and they're saying, hey, I'll give you cash for keys if you move out. And so, and this relocation amount is negotiable. So sometimes I'm hearing stories that renters are getting like $50,000 or $30,000 in relocation. You could take that and apply it to a down payment. So instead of looking at it as like a negative that you have to move out, it could turn into a positive. Now, you know, what could you do with $50,000 right now in LA? There's not much you can buy, you know, but as TICs become more popular, there's going to be more inventory that would allow you to get something without down payment.
We see gifts quite common. It's, you know, clearly a pretty regular occurrence right now. People need gifts to help get into the market, so that's fine. There is one caveat I will point out: if you have a gift coming in for 20% or 30%, that's fine. The bank will still want to evidence that you have 5% of the funds in the transaction sourced in your name. In other words, it will want to see that you do have 5% of the equity required in an account in your name. Even if you're not going to use it, they will want to see that you've got some. In other words, receiving a gift for 100% of a transaction that you're going to put for down payment doesn't correctly. You're going to have at least some funds already seasoned in your name.
And how long do you want to see it seasoned?
Generally, that can be, I mean, we're going to basically look back 60 days with bank statements on seasoning history.
So perfect. So, and this is another thing I kind of wanted to talk about. So a lot of our TIC units are coming up. Like we know what we have in the pipeline. But every day, landlords are calling me saying, hey, I had a landlord call me this week. He has a 7-unit vacant building in West Hollywood. He's 70 years old. He hasn't had tenants in there for God knows how long because he's old and he just doesn't want to, he couldn't maintain it. He couldn't handle the business anymore. So he's left it vacant for years. And he's like, Liz, what should I do? Should I sell the property? I was like, this would be a great TIC opportunity. You have 7 units vacant. Okay. So but he's asking how much can I sell these units for? If you're a buyer or you're a potential buyer right now and you're like, okay, I could potentially save up so much money in 6 months. I could maybe save up $30,000, $40,000. I could have 10% down and reserves for a $350,000 unit. If you told me that today, then I might find something tomorrow that matches what you're looking for. So I guess my point is, like, don't get too hung up on what you have right now and the time frames, because again, even if you're not ready right now, if you contact us and let us know what you want, what you think you're going to get qualified for, or what you can save up in what time frame, like when you'd be ready to buy, we can find something for you, is what I'm trying to say. Does that make sense?
Mm-hmm. Yep.
Okay,
Absolutely.
so let's move on. What happens after the offer accepted? So let's say you get pre-approved for a loan, you write an offer, your offer gets accepted. During escrow, it's very similar process to a regular escrow. You have loan condition. Yep. And then Henry, talk to us a little bit about what the lender requires.
Well, there's a lot. I mean, it's a mortgage loan, so just be prepared to, hand over your everything to do with you. So, we're going to ask for obviously income statements, bank statements, and there's just many other things that we'll go through. We'll order the appraisal, and then through the process of loan conditions, there'll be the loan approval, and then it will be subject to obviously a number of conditions. Underwriting will want to clarify a number of things. They will want to see that your funds to close are liquid. So if you have your funds in mutual funds, let's say, you will need to liquidate those before the end of the underwriting process. Or if you're going to realize a gift, you will need to complete the funds and sign a gift affidavit. So all those things will need to be lined up, and that's kind of the point of the underwriting condition process. The appraisal will be ordered in the meantime. That will be returned. We'll confirm the units at value, and that will be reviewed. And then there is, of course, the TIC agreement, which we'll need to receive. Now, we're working, generally speaking, there are a few attorneys up in San Francisco that are now active in Los Angeles. And so most of their TIC agreements already come basically tailor-made for our lending process and for the types of buildings we're talking about here. Once all of these processes are in and through and we're done, then you can remove the financing contingency. Sometimes there might be a few non-material items left to do before you release that, but we'll obviously gauge that everything's generally okay on the up and up for you to release your financing contingencies. One of the items Sterling does have is that it will ask you to establish a Sterling bank account. You will manage your mortgage payment through Sterling during the loan process, and we'll help you establish all that, and that'll be part of the, we'll get that in, you remove your contingencies. But really a process no different than a standard mortgage process.
And the TICA is the Tenants in Common Agreement, and that agreement is basically like a CC&R, like a condo's CC&Rs. It's the rules and regulations that sort of govern the TIC community. And like Henry was saying, there's a TIC attorney in San Francisco, Andy Serkin, who sort of pioneered TIC sales in San Francisco in the 80s. We've been using them to prepare our TIC agreements for all of our sales. It's a solid agreement, and you want a really good agreement. You want to make sure you have a really good agreement on your TIC purchase. And you'll have an opportunity to review it and go in, into the nitty gritty and see what it's all about during the escrow period. So after you close, that's when the new TIC community is formed. It's an HOA, it's a homeowners association. So it's just like a condo. The new owners will get together and have meetings. You will decide together if you want to paint the building purple, or what repairs you want to do, if any. And then also, we set up all our TIC communities with a finance manager. So you'll have an HOA manager who will collect the HOA dues and pay the bills every month. Anyway, it's very similar to buying and owning a condo. And it does sound a lot like a condo, and that's because it's very, very similar. So now let's talk a little bit really quickly about the difference between a condo and a TIC. So with a condo, you take a 4-unit apartment building, you can convert it to condos to go through the city and the state. Each unit will get its own assessor parcel number. So it'll be subdivided. And this is regulated by the city. There's restrictions that apply, and it's very costly and time consuming to do a condo conversion. When you buy a condo, you're buying everything within the walls of that unit, and then you share all the common areas you own mutually with everybody else in the building. With tenants in common, there's one property, there's one assessor parcel number, and the property remains as a multi-unit building. Each buyer is buying a fraction of the property, and the city doesn't get involved at all. The TIC agreement stipulates which unit you have exclusive rights to. So you're buying, let's say it's a 4-unit building, you're buying 25% of the property, and you have exclusive rights to 1 unit. Okay, and that pretty much is the end of our webinar content, and let's just take a few moments to do some question and answers, Henry, if you have a few more minutes. So I kind of want to address a few questions that frequently come up to me, for me. And Brita, can you pipe in if anyone's asked any questions specifically too? But I often get questions from buyers about the property taxes. How are the property taxes paid? Do you want to answer that question, Henry?
Oh, me, sure, yes. So property taxes are paid based on the assessed value of the unit you purchase. So you purchase a unit for $400,000. You're the local tax basis against $400,000. That forms your taxes. Now, the city will essentially still provide one tax bill to the building. It is still one parcel, so there is still one tax bill moving forward. However, generally speaking, all TIC buildings begin to account for the different tax bases for everyone in the building, and that will essentially then form the entirety of the whole tax bill. So you'll be paying your share based on purchase price and the tax rate But one tax check or multiple tax checks can be sent in, but altogether you still have to pay the tax bill as one payment. In other words, because it is still one tax bill against one parcel. So it's a little bit of a divided sort of tax situation based on ownership, but then it's all sent in together. Keeping in mind that while the mortgages are fractional, taxes and insurance are still remaining shared obligations on these TIC buildings, on TIC ownership.
Yeah, and so to clarify, because a lot of buyers are concerned, well, if the neighbor sells their unit 5 years down the road for twice as much, the whole property tax bill is going to go up, but your portion is still going to remain the same. So your portion of property taxes is always going to be based on your purchase price. The new
Correct.
buyer of the property that was recently sold, they're going to be responsible for the increased amount. So that just to clarify that.
That's correct, and there'll be a supplemental eventually. Either Los Angeles and in San Francisco, it takes about 6 to 8 to 12 months for the city to send out the supplemental bill, which will then obviously show the difference now, the new tax, and then you can just simply allocate and account for how much is for the new purchase. But generally speaking, no, the transfer of another share in the building does not impact your tax basis, just the one of the sold unit, of the transferred unit.
And it might seem daunting for like new homeowners to try to figure all this out with the property taxes and who pays what and what happens when something's sold. So that's why we've started to set up our TIC communities with Ted, who's a TIC manager, finance manager. He's actually in San Francisco, but he manages these buildings for us here in LA. He's very reasonable. He's $30 a door per month. So, it's a small price to pay to know that he's just going to handle all the numbers. So you don't really have to worry about it. Just know your property taxes is going to be based on your purchase amount, just like if you were buying a condo, and let Ted deal with the headache of figuring it out. It's not really a headache for him. That's
common up here. Most buildings, especially if it's 3 units or larger, any 4 and 5, 6 unit, et cetera, building, and there's buildings as large as 18 and 30 units, but they all employ account managers to help them sort through and make sure the accounting is done just right. So.
Yeah, it's pretty reasonable. So I can see that. Okay, so another question that buyers often have is, can I sell my unit whenever I want, or do I have to get permission from other people in the building to sell my unit? And sort of the beauty of TIC sales and fractional loans is that you don't need permission from anybody else. You can buy it, sell it, rent it, live in it, just like it was a condo. You don't need permission from anybody else. And that brings me to another question about renting. Can I rent my unit? So that's another thing that we do. We set up all our TIC communities with as few rental restrictions as possible, because what we've found is that the buyers who are coming through our open houses and who are looking at our TIC units, they're asking us, they're telling us, we want to be able to rent it. So, right now, Los Angeles doesn't have restrictions on Airbnb, but there might be restrictions in the future. So as far as Airbnb, that's going to be dependent on what the city restrictions are. But renting out your unit, you can buy it and you can rent it out. And with Henry, with getting the loan, so Henry, you do allow your buyers to rent out their units. You have to put a little bit more down, and it's a slightly higher interest rate because it's an investment loan. But it's still a possibility. It's still reasonable. And as long as you go through you do that, you can rent it out. We require about 25% down. I think we can do up to 75% financing on investment if that's the intention, is to investment occupy and buy it as a tenant occupied investment. Or in the future, if you've lived in it and after a certain number of years you decide you want to move, rent it out, that's fine with us as well. So I just want to say,
a common practice.
If you want to buy it and rent it out, and this is something that probably a lot of the buyers who are on this webinar aren't really thinking about, because this is like what investors think about. Like if an investor wants to buy a property and then rent it out, they're looking at how much do I put down and how much is the rent going to be? Is the rent going to be able to pay my mortgage and my expenses? But I just want to take a second to talk about this, because this is what is so exciting to me about TICs. It's giving an opportunity for a normal person like me and the people on this webinar to get into investment. Like, you don't have to have $3 million to buy an apartment building. And if you do buy an apartment building, by the way, you have to have more than 25% down. You have to, the minimum to get in is probably 35%. So you can get into this investment with 25% down, and have, with TICs, have the mortgage have the rents pay your mortgage. And that's like really hard for investors right now in Los Angeles. Every investor is looking for a property where the rents pay for the mortgage, where they cash flow. And it's very difficult to find something where you can put 25% down and have the rents pay the mortgage. And TICs provide that opportunity. And so this is so cool for normal people to get into, to become like what we're calling the mini investors. I think like that's the coolest thing. So,
hey Liz.
Yeah.
One question. So somebody has a question for about renting the units, and you guys already answered part of that. Is there any, sometimes with condos, the CCNRs have restrictions as to like how many units in the building can be rented. Are there any restrictions with the TICs?
Well, we don't have any restrictions. In other words, we don't really screen. If there's a 6-unit building and 5 of the units are tenant occupied, and 1 unit is being now considered to be purchased as primary residence, that's fine with us.
Okay.
So that would normally be considered an over-concentration of investment units, but for TIC purposes, we're fine for fractional financing. So,
yeah. Cool. Let me see if there's any other questions or any other frequent. Let's talk about property taxes one more time. So again, what happens if somebody doesn't pay their property taxes or their HOA? What are the negatives of TICs?
Remember, it's a co-ownership arrangement. So, everyone is together. It is a shared obligation. The mortgages themselves, that's separate, but the insurance and the taxes are still the shared obligation. So if someone in the building cannot make their tax payment or their HOA payment, well, you need to actually address that collectively as a building. Now, maybe in the short term, you still need to pay the tax bill, the insurance bill, so maybe the HOA then has enough to cover the shortfall in the short term, and you can still then make the payment on time. But on the long term, of course, the issues need to be addressed. They usually are addressed pretty quickly, certainly in San Francisco, if someone's unable to pay. And again, it does sometimes come down to the strength overall of the HOA on a given building. So HOAs need to make sure they're formed, they have reserves, they've got policies in place, and they're ready to deal with issues like this. I don't think we see it a whole lot in San Francisco, but it can certainly happen. And that knowing that those are still shared obligations, everyone needs to be prepared and ready for those situations. If it's a long-term situation, clearly it needs to be addressed. And most tenancy in common agreements, that's where the language becomes important. There will be some language specifically related how to deal with this situation, how to deal with HOA payments not happening, to tax payments, etc. So there is specific verbiage that will address those circumstances.
Yeah, I've talked to Rosemary at Andy Serkin's office a lot about this, and their agreement, again, it's a very tight agreement. And so they have taken all these different scenarios into account, what could happen, what's the worst that could happen, and how to remedy it. And a couple things I want to point out. One is Sterling Bank. Henry, you guys do an impound account for property taxes and insurance.
Correct.
You're going to be collecting in advance. When you close escrow, you're collecting the payments in advance. So you've got a little bit of cushion there, A. Right. And B, the TIC agreement also stipulates that the HOA has to have a reserve account for these things. So there will be a cushion in the HOA. If someone doesn't pay it, there's going to be a cushion to pay it, and then there's a remedy to collect it from them or for closing their unit. So there's which is not too different than a condo.
Right.
Which is the HOA dues. Okay. So if there aren't any other questions, I think we've covered a lot. We've been talking for an hour. Rita, are there any other questions?
Nope, that's all.
Awesome. Okay, well, thank you everyone for joining. And Henry and Rita, thank you guys for your time. And again, last thing I will say, Definitely contact us, reach out to us, let us know what you're looking for, what price point you think you can qualify for, and we'll start matching you up with other buyers looking for similar units and properties, and we'll match you up with we can find you a property to buy. So thank you for joining us, and we'll see you guys soon.